Hello and welcome back to Game of Trades, your #1 channel for videos on the stock market and cryptocurrencies. This video is going to be focused on the stock market. We have the 2-year bond yield here that's just rising exponentially over the past few weeks. This is a typical indicator of recessions. We're seeing the number of IPOs begin to spike up again, showing us that market participants are once again getting very excited about the stock market. And we have the yield curve, the 10-year minus the 2-year, heading straight into zero, which is typically the range where you start to have recession risks absolutely skyrocket. So a lot of investors are getting concerned about this. Is it time to exit the markets? The number of questions we've had in the comments section and on our website at gameoftrades.net regarding this is astounding. Lots of panic. So we're going to be addressing that in this video and telling you guys exactly what we think of this market right now. If you're interested in following these crazy markets with us, make sure to click on that subscribe button. If you enjoyed this video, do not forget to smash the like button. It is really appreciated. And now without further ado, let's get right into it. So I want to start off with this chart here of the ratio between leading and coincident economic indicators. Now, this is a chart from Yardeni.com. They provide a ton of great data. We take their data into account a lot when we do our research, our analysis on Game of Trades. And so this is typically one of the indicators that we use because it's so simple to understand. When you've got the ratio of leading to coincident economic indicators that's going up like it is right now, it's telling you that the economy in the future looks brighter than it is now. So this type of move up here that we saw in December, this is the data set from December, is showing us that the economy has a bright future in the months ahead. Now, what happens when you've got a slowing economy? Well, you have this ratio that starts to curl back down, and you can see this happens every time before recession. In 2006, you already had this ratio start to begin pointing down here. In 1997 to 1999, same thing. It was starting to point down before the markets topped and much before the recession. Same thing in the late 80s before the 91 recession. I'm not going to go through all of them, but every time you have a big recession, you see this ratio going down before it happens. So that's one of the things that we watch. Of course, it's not an absolute. It's not the only thing we watch, but it's definitely comforting seeing these numbers in December. And this is not a chart telling us that we should start to panic just yet, despite some of those developments that we're getting on the yield curve. And that's where I want to jump to this chart of the yield curve, right? We're currently heading straight to zero. This is the 10-year minus the 2-year, right? So it's the difference in bond yields between long-term bonds and short-term bonds. But you don't need to understand too much of that. What you need to understand is that when this goes to zero and it starts to invert, that's called an inverted yield curve, and it's a pretty good, accurate indicator of a recession. It's telling you that monetary policy has tightened significantly and that the economy is not likely to be in a good shape in the months ahead, right? And you can see what's very concerning. A lot of people are talking about this. A lot of doom and gloomers are saying that this is the end of the world because we're heading straight to zero and that a recession is going to happen within the next few months. Let's quickly take a look at that because I don't like jumping to those kinds of conclusions too quickly. We're currently in the same place that we were back in these moments, and that's 2018, 2005, 1997, and 1988 here. And in fact, you can even add 1994 here and 1998 here, because what we're looking for is every time the yield curve has crossed down below this exact point where we are. So it crossed down here, it crossed down in 2006, it crossed down in 1998, in 1998, in 1997, in 1994, and 1988. So let's quickly take a look at that here and add the S&P 500 on top of this chart to see how stocks performed every time you had a very similar situation to now. And if we can figure that out, we can know exactly how scary the yield curve currently is. So in 2018 here, it crossed down, right here. In 2005, it crossed down here. Then again, we had these crosses back in the late 90s, multiple crosses of this level on the yield curve throughout the 1990s. And then in 1998, right here, you had another cross. So just at a quick glance here, you've got 1, 2, 3, 6 data points. Now let's take a look at how stocks performed short term following those crosses. Here you had a very strong rally in 1998, 1999, and 1990. Here, this was the beginning of a very strong run on the stock market as well. In the late 1990s, you had a huge stock market performance here in the years following those readings. Same thing in 2005. Now in 2018, it was a little bit worse performance, but it was still a good moment to be buying the dip on equities when you had the chance. So just the summary of what we're saying here is that the yield curve right now doesn't look that bad. In fact, historically, it's still the moment to be buying the dip on the S&P 500. What do we have right now? We've had a 12% correction on the S&P 500. I call that a pretty big dip. All right, so if economic indicators are pointing up and we're not in the part of the cycle where we should be selling our equities, why are we seeing so much volatility? Why did we see that 12% correction? So let's talk about that for just a second. By the way, if you're so far enjoying this episode, make sure to smash the like button. There's a lot of effort and time that goes into making these videos. I'm very proud of the content that we produce. Hopefully, we're helping as many people as possible, learning how to navigate the market, learning how to properly look at the stock market. If you appreciate those efforts, don't hesitate to leave us a like. So let's talk about that volatility. Now, we already talked about this. A large part of what's fueling this volatility is yields rising here. We've had a 2-year yield that's just risen parabolically over the past few weeks, and investors need to reevaluate their positioning, right? When bond yields rise, especially the short-term bond yields rise, all of a sudden it's a lot more interesting to be putting money on the side, putting money in your bank account, because you're starting to earn an interest on that money as opposed to keeping it in the stock market. So that's something that typically happens when you have bond yields rise. I can show you a couple of examples of this here. Bond yields rose tremendously in 2018. It led to a sharp correction in 2018. You had the same thing back here in 2004, rapidly rising bond yields here, correction in the stock market. You had the same thing in the 90s, very similar dynamic here. In 1994, big rise in yields, and then you have a stock market correction throughout that rise. The market doesn't like this type of move on the 2-year yield, and that's why we've seen the move that we've seen on the stock market. Now, on the brighter side, as long as you have a favorable economic environment, leading economic indicators are pointing up, and you're still quite a distance away from seeing an inverted yield curve, and of course a bunch of other data that we look at, it usually leads to good buying opportunities, because as soon as you see the 2-year yield begin to pull back or begin to consolidate like it did here in 2004, then you see the bull run just spark up again. Same thing here in 1994. As soon as yields began to pull back, you saw the bull run spark up again. Now, I'm not saying that we're in the exact same scenario that we were back in 2004. In fact, you can clearly see that 2-year yield is just rising at a much, much faster pace, right? We've got 7.5% inflation here. This is just nothing like we've seen throughout the past 20, 30 years. So it could cost us a much shorter economic boom, right? In every case here, the economic boom was 5, 7 years long. Right now, what we've seen throughout 2020, 2021, and 2022 is that we're very likely to see one of the shortest economic booms in our history. And we are getting closer and closer to that point where it is going to be interesting to get out of risk on assets. We're just not quite there yet. And you can see here every time the market seems to break lower. Right, let me put a trend line on this. This is a log scale chart of the 2-year yield. You have a nice trend line, 1, 2, 3, 4 reactions. In each of these cases, 2000 2007 and 2018, these were great moments to be exiting equities, and we are getting to that final phase. Now you can see here we have a little bit of resistance, so I think that we're going to get a pullback on the 2-year yield. And as I said, when you have a pullback on the 2-year yield and you've had a correction on the stock market, it's an opportunity to capitalize on. Now, if you're looking for a website that provides this kind of data that we're looking at and gives systematic and comprehensive overviews of the market by putting all the pieces together and then actually giving a watch list of ETFs to look at to profit from the current market environment, make sure to check out gameoftrades.net. We just opened up brand new trades on the S&P 500 and on the tech sector during the recent correction. So we are going to be following those indices and those trades very closely every step of the way with you guys. For now, the price of the service relative to the data and the information that we provide is just unlike anything that's on the internet right now. We are eventually going to have to raise the prices if we want to stay competitive, but for now, the primary objective is to continue growing this insane community that we have on the website that just makes every comment sections of our articles on the post so interesting and filled with interesting ideas. Now, that's about all I wanted to cover in this episode. I hope you guys enjoyed. If you did, make sure to drop a like and subscribe to the channel if you haven't already. Now, in the meantime, I wish you good luck on your trading and see you next time.